Today, we're diving into New India Assurance, India's largest public sector general insurer. Now, this is a massive state-owned company, and it recently popped up in the headlines with a financial result that was, well, pretty baffling. So in this explainer, we're going to get to the bottom of the mystery behind the numbers.
All right, here it is, the number that got everyone talking. For the third quarter of the 2026 fiscal year, New India Assurance, or NIA, reported a staggering 215% surge in its profit before tax. And no, that is not a typo. 215%. I mean, in an industry this competitive, for a company this big, a number like that is pretty much unheard of.
But this is where the mystery really kicks in. This incredible profit jump, it didn't just happen out of nowhere. It happened at the exact same time the company got hit with a gigantic, one-time expense that really should have crushed its bottom line. So how is that even possible? The math just doesn't seem to add up, right? Well, that's the question we're going to answer.
All right, so let's start by breaking down this central conflict. You've got this massive profit on one side and this huge new expense on the other. It's a total paradox, and figuring it out is the key to understanding how this company really operates. So here's the deal. The company reports this incredible profit growth, but at the very same time, because of a central government decision, it had to set aside a huge chunk of money for employee wage revisions and retirement benefits. I mean, logic tells you that profits should have taken a nosedive, not skyrocketed.
And we are not talking about pocket change here. We're talking about a provision of roughly 2,500 crore rupees. That's a substantial hit to the books by any measure. So where did the money come from to not only cover this cost, but to also report a record profit? It's a real head-scratcher.
Well, the answer lies in this really powerful analogy that analysts use to describe NVIDIA. You have to stop thinking of it as just one company. Instead, you've got to start seeing it as a machine with two very different engines. And while one of those engines was kind of sputtering, the other one was firing on all cylinders. So let's look at these two engines. On one side, you have the insurance engine. This is their day job, right? Selling policies, handling claims. This is the engine that took the full force of that 2,500 crore wage bill. But then, on the other side, you have the investment engine. You see, NIA manages a colossal portfolio of stocks and bonds, and that engine has been performing brilliantly. And you can see the sheer power of that investment engine right here. In just the first 9 months of the fiscal year, its income shot up by 51% to nearly 8,600 crore rupees. And most of that came from capital gains, basically profits from selling stocks in a rising market. With over 1 lakh crore in assets, this engine generated more than enough cash to solve the insurance engine's problems.
And look, you don't have to take my word for it. The company's own chairperson and managing director, Girija Subramanian, said it directly. She acknowledged that the wage provision was a huge hit, but she stated clearly that it was offset by strong performance from their investments. So, there you have it. Mystery solved. But, solving one quarter's mystery just raises a much bigger question. Is this really a sustainable model for a company of this size? Or is NIA just using its powerful investment arm to paper over some really deep-seated problems in its core business? This is where the debate among analysts really starts to heat up. Let's start with the bull case, the case for NIA. First off, there's no denying this company is a titan. It's the market leader with a 13.4% share. It's 85% owned by the government, which gives it incredible stability and trust. It's got a top-tier AAA rating from CRISIL, which is basically a gold star for financial strength. And its solvency ratio? It's comfortably above what's required, meaning it has more than enough capital to meet its obligations. And this really illustrates the sheer scale we're talking about. Look at the product mix. The company is a leader across health, motor, fire, you name it. And then look at its distribution network. They're using brokers, direct sales, and agents to reach every single corner of the market. This kind of diversification is a core strength. So, if everything looks so solid, what's the problem? What's the catch? Well, the concern isn't about its size or its stability. The concern is about its efficiency. When you dig into the core insurance operations, that insurance engine, some worrying trends start to emerge. This right here gets to the heart of the issue. Focus on that number called the combined ratio. It's a key measure of profitability in insurance, and you'll notice that NIA's ratio at 121% is significantly higher than its private sector peers. So what does that actually mean? Well, to put it simply, a combined ratio over 100% means a company is paying out more in claims and expenses than it's collecting in premiums. So, at 121%, NIA is essentially losing 21 rupees on its core insurance business for every 100 rupees it brings in. That's an underwriting loss, and it's being subsidized by the investment engine. And this sharp quote from a market's mojo analysis just sums up the bear case perfectly. Being the biggest doesn't matter if you aren't profitable. The report points out that NIA's massive scale just hasn't translated into strong financial returns for its shareholders, and that's a pretty fundamental problem. So we have these two conflicting views. On one hand, a stable, government-backed giant. On the other, an inefficient, operationally challenged business. So how do analysts reconcile this? What's the long-term verdict? Many analysts describe NIA as a deep value play. Think of it this way. It's not a stock for quick gains. It's an investment based on the idea that the company's assets, its massive investment portfolio, its real estate, are actually worth far more than the current stock price. But all that value is sort of locked behind those operational problems. So, the crucial point is this. The long-term strategy isn't just to let the investment engine cover losses forever. The strategy is to use the profits from investments to buy time and fund a complete overhaul of the core insurance business, to fix the inefficiencies and unlock that hidden value. And this slide lays out the 4-step playbook that management is following. Step 1, use that investment income as a buffer for shocks. We've seen that in action. Step 2, focus on improving underwriting to cut costs. Step 3, launch new innovative products for growing sectors. And finally, Step 4, leverage digital transformation to make everything more efficient.
Now, let's zoom out for a minute, because this story isn't just about one company. It's really about the future of insurance in one of the world's fastest-growing economies, and NIA is right at the center of it all. You can see here just how much room there is to grow. I mean, compared to a lot of other countries, India's insurance market is still massively underpenetrated. For a market leader like NIA, this represents a golden opportunity for long-term expansion as more and more people seek financial perfection. And this isn't just a market trend, it's a national priority. The Indian government has this big vision called Insurance for All by 2047. To achieve that, they need their largest state-owned insurer to be a primary engine of that growth. This government backing and alignment with national goals is a huge advantage for NIA. So we end where we began, but with a much deeper understanding. That 215% profit surge wasn't a miracle. It was the result of a powerful investment engine covering for an inefficient insurance engine. The real question is whether the company can use this strength to fix its core weaknesses and truly awaken, or if it's going to remain a legacy giant just struggling to keep pace with a changing India. That's the billion-dollar question that investors are watching.